All right, let's dive into a really fascinating report that tries to unpack a huge puzzle in the world of cybersecurity. What is going on with Palo Alto Networks?
So check this out. This is the mystery right here. Palo Alto Networks, you'll see their ticker is PANW. They report what looks like a stellar quarter. I mean, revenue climbed 16% to a whopping $2.5 billion. But the market's reaction? A shrug. The stock actually dipped a little bit. So what gives?
In this chart, it just lays out the disconnect perfectly. On the left, you've got this solid 16% revenue jump. And on the right, a basically flat, even slightly negative stock reaction. Now, the analyst report we're breaking down today says this is where the real story is, and that the market might be totally missing the bigger picture.
Okay, so to understand that disconnect, we have to look at this massive strategic shift that's happening inside the company. This isn't just about selling more of the same stuff. No, this is about changing the entire game.
This slide really gets to the heart of it. See, the old Palo Alto Networks, they sold hardware, physical firewall boxes. It was a transactional business, a one-time sale. But the new Palo Alto, it's all about what they call platformization. They're moving to a single, integrated platform that you subscribe to. The best way to think about it? It's like they're convincing you to trade in your entire messy DVD collection for one clean Netflix subscription.
So, why are they making this huge shift? Well, the report says they're trying to solve this massive headache for businesses called agent fatigue. Just imagine you're on a security team and you're juggling dozens of different tools from dozens of different companies. Nothing talks to each other, it's a total mess, it's inefficient, and it leaves these huge gaps for attackers. Palo Alto wants to be the super aggregator that just gets rid of all that chaos. And this right here is why that headline 16% growth number is so misleading. The real action is in their next-gen security business, that new subscription platform. And as you can see, that part of the business is growing at a blistering 29%. They're basically eating their own lunch here. The new, high-quality recurring revenue is just gobbling up the old hardware sales. The report calls it a planned cannibalization, and from the looks of it, it's working.
Okay, so if the new strategy is so strong, why is Wall Street kind of hesitant? Well, the report digs right into the two biggest doubts that seem to be spooking investors.
The first big red flag that popped up for investors were these headlines about the CEO, Nikesh Arora, selling a massive chunk of his stock. And on the surface, that looks really bad, right? I mean, is the captain of the ship jumping overboard?
To really get what happened, we gotta quickly break down this term from the report, phantom stock. I know, sounds kind of complicated, but it's basically a bet on the future. It lets an executive delay taking ownership of their shares, betting that the price will be a lot higher when they finally cash them out years down the road.
And this is the absolute key. The report's analysis of the SEC filings, the boring legal stuff, found that the CEO didn't actually sell his shares on the open market. He moved them into that phantom stock plan, which he cannot touch until 2027 and 2028. So what looked like a vote of no confidence is actually the complete opposite. It's a massive, long-term bet on his own company's success.
All right, so that's doubt number one. Let's move on to the second big worry. A metric that investors watch really closely, called billings, has been slowing down. And that's led a lot of people to worry that customer demand is just drying up. But again, the report says that's not what's happening at all.
The twist here is that this slowdown is a deliberate choice. It's happening on purpose. See, Palo Alto is actively pushing customers away from paying for, say, 3 years of service all at once. They're moving them to simpler annual contracts. Now, yeah, that means less cash in the door today, and that's what hurts the short-term billings number. But the goal is to build a much healthier, more predictable business for the long haul.
So, if billings isn't the number to watch, what is? The report points to this number as the real true north for demand. $15.5 billion. This is their remaining performance obligation, or RPO. You can basically think of it as the total value of all the contracts they have signed for future revenue. And that number grew by a massive 24%. According to the analyst, that is the real signal of the company's incredible strength.
So now, we get to the most dramatic part of the whole story. To pour gasoline on this platform strategy, Palo Alto Networks is making some absolutely enormous bet-the-company kind of moves. $25 billion. Just let that number sink in. That is a reported price tag for the proposed acquisition of another cybersecurity giant, a company called CyberArk. A deal this big would be one of the largest in the history of the entire tech sector.
And they are not stopping there. The reports also suggest that at the same time, they're scooping up another company called Chronosphere for over $3 billion. I mean, this is an incredibly aggressive, all-in strategy.
And this slide right here, it shows you the master plan. They started with their core business in network and cloud security. Then they layered on AI operations. Now, if these deals go through, with CyberArk they add identity, which is all about verifying who a user is. And with Chronosphere, they add observability, which is about understanding what the systems are doing. The end goal is to build a single, unbeatable platform that covers every single angle of modern security.
So, after all that, what does the analyst think? Let's get to the final verdict, the price target, and of course, the major risks that could blow this whole story up.
First up, let's talk valuation. You can see Palo Alto right here, trading at about 54 times what analysts expect them to earn. It's smack in the middle of its competitors. It's cheaper than the high-flying cloud companies like CrowdStrike, but it's more expensive than the legacy hardware guys like Fortinet. The report basically argues that this is a bargain, given how successfully they're pivoting to this much better platform model.
And so, the bottom line from the report is this: a clear buy rating, with a price target of $255. Now, based on where the stock was when this report came out, that represents a potential upside of about 28%.
This whole recommendation really stands on three big ideas. First, the absolutely game-changing potential of combining network security with user identity. Second, they're using AI in a way that's actually making their own operations cheaper, which is boosting profits. And third, that massive $15.5 billion backlog of future revenue we talked about earlier.
But of course, a bet this big comes with huge risks. I mean, trying to smash these massive companies together could be a total integration nightmare. You also have some customers who might get nervous about vendor lock-in and decide they don't want to put all their security eggs in one basket. And finally, when a stock is priced this high, it's priced for perfection. Any little slip-up could cause the stock to fall, and fall hard.
And that really brings us to the final critical question that this entire strategy hinges on. Palo Alto Networks is betting everything, billions and billions of dollars, on the idea that as the world gets more complex, customers will crave the simplicity of a single security platform. The big question for the whole industry is whether this kind of super vendor consolidation is the future, or if putting all your digital trust in one place is a risk that's just not worth taking. That's the billion-dollar question. Thanks for tuning in.